The International Monetary Fund has sounded an alarm. Renewed trade tensions, especially between the United States and China, could threaten global economic growth. It's a warning that's resurfacing just as inflation begins to cool and markets start to stabilize. But beneath the headlines lies a deeper story, one about shifting alliances, fractured supply chains, and a global economy trying to find its footing in a world that feels increasingly divided. In its latest World Economic Outlook, the IMF highlights a growing concern: the return of protectionism. After decades of globalization, where goods and capital move freely, nations are now turning inward. Tariffs, export controls, and technology restrictions are rising again, creating invisible borders that slow the flow of global commerce. According to the IMF, if this trend continues, the world could lose up to 7% of global GDP in the long run, roughly equivalent to wiping out the combined economies of France and Germany. That's not just a number, it represents lost jobs, higher prices, and reduced innovation. The IMF's message is blunt. Even as inflation and interest rates stabilize, fragmentation, the splitting of global trade networks, could become the next big economic shock. And in this new landscape, no one is truly insulated. Not the major economies, not emerging markets, and certainly not consumers. At the center of this new economic friction are two global giants, the United States and China. Once deeply intertwined through trade and investment, their relationship has morphed into one of rivalry and suspicion. The U.S. continues to limit China's access to advanced semiconductors, artificial intelligence tools, and cutting-edge chip-making equipment, all under the banner of national security. China, in response, is restricting exports of critical minerals and key components needed for everything from electric vehicles to defense systems. What began as an economic dispute is now a geopolitical power play, one that reaches far beyond Washington and Beijing. Countries like Vietnam, Mexico, and Malaysia are seeing new investment as manufacturers diversify, a phenomenon called the China Plus One strategy. On paper, it looks like opportunity, but for these countries, it's a balancing act. Attract business without angering either superpower. Even commodities are caught in the middle. Copper, lithium, and nickel, once simple raw materials, are now strategic assets. Their prices fluctuate not just with demand, but with political tension, export bans, and policy tweets. And it's not just about trade. The IMF warns that financial fragmentation is emerging too, where payment systems, currency reserves, and capital flows split along political lines. If the US dollar faces growing competition from China's yuan or regional payment systems, the structure of global finance itself could begin to shift. Let's zoom in on one critical example. Rare earth elements, the 17 minerals quietly powering modern civilization. From smartphones and satellites to wind turbines and fighter jets, these elements make advanced technology possible. China dominates this market, controlling about 70% of global production and an even larger share of processing capacity. So when Beijing restricted exports of gallium and germanium, two essential materials for semiconductors, Western industries felt the shock instantly. Factories scrambled for alternatives, and chip prices jumped within weeks. It's a reminder that supply chain security has become as important as national security. The IMF warns that relying too heavily on a single supplier for such materials could leave the world vulnerable, just as dependence on Middle Eastern oil shaped global politics in the 20th century. Today, nations are racing to secure access to these resources. The U.S. is investing in domestic mining. Japan and Australia are forming alliances. The EU is funding new recycling technologies, but rebuilding capacity takes time, and the race for control of critical minerals is quickly becoming the new economic frontier. For Europe, especially the UK and EU, this tension carries major consequences. European industries like automotive, aerospace, and renewable energy depend heavily on imported components and raw materials. A breakdown in U.S.-China trade could hit European supply chains directly, raising costs and slowing down the green energy transition. That's why the EU's new Critical Raw Materials Act focuses on diversifying supply. Partnerships with Australia, Canada, and Namibia are being developed to reduce reliance on Chinese processing. But there's another challenge: competition. The United States is offering major subsidies through its Inflation Reduction Act, drawing clean energy investment away from Europe. If the EU can't respond at a similar scale, it risks losing both capital and talent. The UK, post-Brexit, faces an even tougher balance, aligning strategically with the US while still depending heavily on Chinese imports. Europe's economic future may hinge on how well it navigates this increasingly delicate trade triangle. If the current trajectory continues, the world could split into three major economic blocs: a US-led West, a China-centered Asia, and a loose group of emerging economies playing both sides. This shift could redefine global growth. Production might move closer to home, what economists call nearshoring or friendshoring. Emerging markets like India, Indonesia, and Vietnam could see short-term gains as new factories open their doors. But there's a price: higher costs, slower innovation, and the loss of efficiency that globalization once offered. Even inflation could rise as goods become more expensive to produce and transport. For investors and policymakers, the question is no longer, will globalization continue, but what will replace it? A world where trade depends on political alliances rather than economic logic could be more volatile and less predictable. The IMF's warning isn't just about numbers, it's about trust. Global growth depends on the assumption that nations can cooperate even when they compete. And if that trust erodes, rebuilding it could take decades. The question isn't just whether the IMF is right, it's whether the world is listening. Because when two giants collide, the tremors are felt everywhere, in supply chains, in markets, and in the price of everyday goods. Thanks for watching. Don't forget to like, subscribe, and share your thoughts.